Welcome students. Previous videos we see national income. National income is the flow of goods and services produced in a country during a year. It includes only those goods or services which are actually produced. We also see circular flow of national income. So students, this video see next topic, different concept of national income. See, there are different concepts in national income. First, gross domestic product. It means GDP. What is meant by GDP? See, gross domestic product is the gross market value of all final goods and services produced within the domestic territory of a country during a period of 1 year. That means GDP is equal to C plus I plus G plus X minus M. And you know that what is meant by C, I, G, X minus M. So students, C means private consumption expenditure, I means domestic private investment, G means government's consumption and investment expenditure, and X minus M means net exports value. That means value of exports minus value of imports. This is the first concept of national income. Then second concept of national income, net domestic product. That means NDP. Net domestic product is the net market value of all final goods and services produced within the territorial boundaries of a country during a period of 1 year. NDP is equal to GDP minus depreciation. The next concept is a gross national product. That means GNP. So what is meant by GNP? Gross national product means the gross value of all final goods and services produced annually in a country, which is the estimate according to the price prevailing in the market. That means GNP is equal to C plus I plus G plus X minus M plus R minus P. R means receipts from abroad and P is equal to payments made abroad. Then next concept of national income is a net national product. That means NNP. Net national product is the net market value of all final goods and services produced by the residents of a country during a period of 1 year. NNP is equal to GNP minus depreciation. Okay students, we see next point, methods of measurement of national income. There are three methods of measuring national income. First, output method or product method. Second, income method, and third, expenditure method. So we see first output method. See students, output method. This method of measuring national income is also known as product method or inventory method. This method approaches national income from the output side. According to this method, the economy is divided into different sectors such as agriculture, mining, manufacturing, small enterprises, commerce, transport, communication, and other services. The output or product method is followed either by valuing all the final goods and services produced during a year at their market price, or by adding up all the values at each higher stage of production until these products are turned into final product. While using this method, almost care must be taken to avoid multiple or double counting. To avoid double counting, this method suggests two alternative approaches for the measurement of GNP. That means in this method, for the calculation of national income, the economy is divided into different sectors such as agriculture, mining, manufacturing, small enterprises, commerce, transport, communication, and other sectors. The value of output of each of these sectors is calculated. The national income is calculated either by the final goods approach, the final product approach, or by the value added approach, the value added method. In the final goods approach, the value of all final goods and services produced in primary, secondary, and tertiary sector are included, and the value of all intermediate goods are ignored. For example, bread is the final good. The price of bread includes the cost of wheat, making of flour, etc. Therefore, the value of all only final product, that means bread, is included in the national income. So, first point, final good approach, the final product approach. Final good are those goods which are ready for final consumption. According to this method, value of all final goods and services produced in primary, secondary, and tertiary sector are included, and the value of all the intermediate transaction are ignored. Intermediate goods are involved in the process of producing final goods, that is the final flow of output purchased by consumer. Hence, the value of all final output includes the value of intermediate products. For example, the price of bread includes the cost of wheat, making of flour, etc. Wheat and flour are both intermediate goods. Their values are paid up during the process of production. In the final production, that means bread, the value of intermediate goods are already included. Thus, a separate accounting of the values of intermediate goods along with the accounting of the value of final product would mean double counting. To avoid this, the value of only the final product or goods must be computed. Okay, students, we see next approach, value added approach. The value added method, it is known as value added method. In order to avoid double counting, value added approach is used. According to this method, the value added at each stage of the production process is included. The difference between the value of final outputs and inputs at each stage of production is called the value added. Thus, GNP is obtained as the sum total of the value added by all the different stages of the production process till the final output is reached in the hand of consumers to meet the final demand. This can be illustrated with the help of following table. Value added, each stage is calculated by deducting the value of inputs from the value of output produced. The sum total added the different stage make GNP. In the above table, the value of final goods, that means shirt, is rupees 500. The sum total of values added at each stage of production is also 500 rupees. Thus, the total value added is equal to the value of final goods. That means 150 plus 100 plus 150 plus 100 is equal to 500. This is a value added method. Okay, students, when we use this method, that means output method, then we should be taken some precautions. First precautions is to avoid double counting. Only the value of final goods and services must be taken into account. Second precautions is goods used for self-consumption by farmers should be estimated by a guesswork. Impute value of goods produced for self-consumption is included in national income. Third precautions, indirect tax included in the market price are to be deducted, and subsidies given by the government to certain products should be added for accurate estimate of national income. Next one, while evaluating output, changes in the price level between different years must be taken into account. Next one, value of export should be added and value of import should be deducted. Depreciation of capital assets should be deducted. Next one, Sale and purchase of second-hand goods should be ignored as it is not a part of current production. Output method is widely used in the underdeveloped countries. However, it is less reliable because of the margin of error. In India, this method is applied to agriculture, mining, and manufacture, including handicrafts, but it is not applied for transport.